Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Strategic planning is the process an organization uses to set its direction and make decisions that help achieve its goals, mission, and vision. We're going to look at an efficient approach to strategic planning, which is a structured way for companies to reach their objectives in a practical and effective manner. This approach supports sustainable growth and helps build a competitive advantage. One key part of this process is defining the mission, goals, and objectives clearly. For example, an engineering, procurement, and construction contractor might have a mission to deliver quality infrastructure at competitive prices, aiming to maximize shareholder value. Their objectives could include growing the business both organically and through acquisitions in a specific market, like Eastern Europe, targeting a 200% increase in turnover and EBITDA within 5 years. It's important that these objectives are backed by measurable goals with clear deadlines, so progress can be tracked and success can be ensured. Position audit gives senior management a clear understanding of where the business currently stands. It looks at whether the organization's goals and objectives have been met and compares turnover with profitability to assess financial health. The audit also examines how well working capital is managed and whether the company can service its debts while providing returns to shareholders. Employee performance and whether key management are meeting their goals are reviewed, alongside an evaluation of the organization's information systems to identify any critical gaps. The efficiency of sales processes, the strength of the order book, and contract pipeline are considered, as well as identifying future business development opportunities. Finally, the company's financial performance and strategy are assessed to ensure they support future growth plans. This process inevitably results in a list of actions that must be carefully planned and managed to capitalize on opportunities and address potential threats. A business position audit offers a clear snapshot of where a company stands right now by systematically assessing its current strengths and weaknesses. This step is essential before planning future strategies. A key part of this process is the corporate appraisal, or SWOT analysis, which examines strengths, weaknesses, opportunities, and threats. Strengths and weaknesses are usually internal factors, such as what the business does well or struggles with, while opportunities and threats come from external conditions impacting the organization. Strengths can include things like the business's unique advantages, product capabilities meeting customer needs, competitive edges such as better distribution or technology, innovation, unique selling points, valuable resources or a strong team, experience and knowledge, and effective processes or IT systems. Evaluating these helps understand the current position before developing a long-term strategic plan. When analyzing weaknesses, it's important to consider areas where the business or product may fall short, such as gaps in capabilities, market needs, or competitive position. Financial constraints like high debt, poor processes, missing accreditations, and limitations on IT or communications also factor in. Opportunities come from market developments, competitor vulnerabilities, geographic or export possibilities, seasonal trends, current styles, and niche segments that could be exploited. Threats include political and legislative changes, environmental pressures, advances in technology that could reduce demand, new competitors, shifts in consumer demand due to economic downturns, and new distribution methods like e-commerce that might challenge traditional retail channels. The key to leveraging opportunities effectively is to align them with the organization's core strengths. For example, a livestock farm could take advantage of growing fast food markets by supplying chicken pieces to fried chicken outlets, especially in developing regions where demand is rising. This approach ensures resources are used efficiently while maximizing potential gains. As the lower middle class grows and gains more disposable income, demand for certain goods and services is likely to increase. It's often easier for a business to expand by building on its existing strengths, such as a chicken producer moving into fast food outlets, rather than branching into something completely unrelated. This kind of organic growth usually requires less know-how, time, and investment compared to entering a new industry. For example, a commercial airline might grow by offering international air cargo services, using its current aircraft to increase revenue and improve cash flow. Strengths can help avoid threats, while weaknesses should be minimized to reduce risks and can sometimes be turned into opportunities. To create an effective strategic plan, conducting an environmental analysis is essential. One common method is the PESTEL approach, which looks at political, economic, social, technological, and legal factors. Political risks might involve government instability or unpaid obligations. Economic risks include changes in interest rates, exchange rates, or inflation. Social risks cover issues like social unrest, labor disputes, or shifting consumer preferences. Technological risks arise when new technologies replace old ones. For instance, Wi-Fi taking over from cable internet or e-commerce, reducing the need for physical stores. Considering all these factors helps a business anticipate challenges and plan accordingly. Legal risk involves changes in laws that can impact a business or project, such as alterations in tax legislation that might negatively affect a company's tax-related cash flows. Competitor analysis, which many companies often overlook, is a strategic tool that evaluates the strengths and weaknesses of current and potential competitors. This analysis helps identify opportunities and threats, enabling a business to adjust its marketing strategy across price, product, promotion, and distribution. It also informs decisions on corporate strategy, including acquisitions, disposals, joint ventures, and organic growth. Typically, a thorough competitor profile includes details like the company's location, ownership, governance, financial health, methods of growth, product offerings, brand strength, patents, and licenses. Understanding a competitor's marketing strategy is crucial, including their advertising approaches, market segments, shares, growth rates, distribution, pricing, and promotional tactics. Additionally, it's important to assess the key strengths and management style of their leadership team and gain insight into their overall corporate strategy, including mission, objectives, and plans for growth or acquisitions. This comprehensive view supports better strategic planning and competitive positioning. When considering how to respond to an opportunity or threat, businesses have several strategic options. These include organic growth, where the focus is on increasing output and sales volume within the existing business or through starting a new venture, which involves assembling a management team and careful planning. On the other hand, strategies like mergers and acquisitions involve combining with or purchasing other companies to expand or enhance market position. Acquisitions specifically mean one company buys another, using a mix of cash, shares, or debt as agreed upon by both parties, with the acquiring company gaining control over the target. Other options include joint ventures, franchising, licensing, exporting, divestment, withdrawing from the market, or rationalizing the business structure. Each of these approaches can be explored further depending on the specific goals and circumstances a company faces. Merger involves combining two companies by bringing their operations together under agreed financial terms, which could include share exchanges, debt, or cash financing. A joint venture, on the other hand, is an arrangement where two or more parties collaborate on a specific project or opportunity, usually contributing agreed equity and share in the profits or losses through a separate legal entity like a limited company. Divestment means selling off a company's asset, essentially the opposite of investing. Sometimes the best option is to maintain the current strategic position without change. Another potential strategy is exiting a market, such as an airline withdrawing from a poorly performing route to focus resources on more profitable ones. Rationalization involves restructuring or turning around an underperforming business, transforming it from cash negative to cash generating. When restructuring is necessary, it should be carefully planned with detailed financial and operational goals included in the company's budget and long-term strategic plan, and closely monitored using financial data and key performance indicators to ensure the plan stays on track. At this stage, each strategic option a company might consider needs to be carefully assessed. This involves looking at both the qualitative benefits and drawbacks, as well as the quantitative impact on the company's projected financial position. After decisions are made and investments put in place, the focus shifts to managing the company to ensure it delivers an adequate return to shareholders. This means maximizing the company's value, meeting obligations to lenders, and maintaining financial health. To do this effectively, it's crucial that the organization has strong processes and controls to monitor and guide performance. The images here reflect this evaluation process, with the first showing analysis tools like financial charts and calculators that help in assessing strategies, and the second depicting a management team reviewing performance data and making thoughtful decisions to keep the company on track. It's important for businesses to develop a comprehensive plan that spans 5 to 10 years and to update this plan annually. This ongoing process helps ensure the organization is prepared both strategically and financially to grow in a sustainable way and to respond effectively to any opportunities or challenges that may arise. The planning should follow a structured approach that includes revisiting the mission statement, reviewing the objectives and targets from the previous plan, and conducting thorough environmental and position analyses, as well as a corporate appraisal. After considering and evaluating different strategic options, the plan should be implemented by the key directors and senior executives with clear, measurable targets set through key performance indicators or KPIs. This disciplined approach helps keep the business aligned and focused on long-term success. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.